Auditing is the process of examining, evaluating of company's statements, records, and operation to ensure they are reliable, accurate, and comply with accounting standards and regulations. It helps build trust by giving stakeholders confidence that the financial information presented are true and fair. There are many types and terms in auditing, and today me and my group is going to present about one of the types. Let's go deep into it. First, I'm going to introduce myself and so do my crewmates. Hi madam, my name is Madan Kumar. I'd like to present. My metric number is 06D8023F1127.
My name is Gayatri Arbuka. My matrix number is 06D8023F1068.
Hi madam, my name is Jivalashmi Muniandi. My matrix number is 1136.
Hi, my name is Nurhani Balkis binti Abdul Kudus. My matrix number is 06D80231112.
Hi madam, my name is Kiru Murugan Analaki Pandurangan. My matrix number is 06D8023F1065.
And today we're going to give information and present about auditing current assets. Current assets are the resources a company owns that are expected to be converted into cash, sold, and used up within 1 year or within a company's normal operating cycle. A common example include cash, inventory, trade receivable, bank, and short-term investment. What are the key categories of that? Liquidity. They can be easily converted into cash. Short-term in nature, used up or realized within a year. A part of working capital, they play a major role in meeting day-to-day expenses and obligations. Fluctuating values. Their amounts often change depending on business activities. There are 4 audit considerations that we should know. First are big assets, confirming that the assets are real and valid. Second is valuation, ensuring they are recorded at the correct amounts. Third is ownership, verifying that the company has the rights to these assets. And final is disclosure, checking that they are accurately presented in the financial statements. What are the audit assumptions for a current asset? For instance, for bank balance, auditors confirm that the amounts records actually exist by obtaining bank confirmation and reviewing bank statement. Number 2 is rights and obligation. For banks, auditors check whether the company owns the bank accounts and that there are no undisclosed restrictions such as pledges, deposits. And complainers for bank is auditors ensure all bank accounts and transactions are properly recorded, including petty cash and overdrafts. Audit assertion for inventory is assertions are auditors perform physical stock accounts and match them with the records to ensure the inventory truly exists. Rights and obligation. For inventory, auditors verify that the company has legal rights over the inventory and that it is not held on consignment or owned by someone else. Complainers. Inventory. Auditors check that all items owned by the company are included in the records, especially goods in transit or stored at third-party locations.
Today I will present about the audit assessment for trade receivable. The extent. The receivable record actually the exists the reporting date and tested a debtor confirmation for the subsequent receipt view. It means the receivable records in the books are real and due from the actual customer. And it's important for company might overstate the receivable by recounting the future sales. And tax example send a debtor confirmation or check subsequent cash collection. Second, right and obligation. The entity has a legal right to collect the receivable and ensure the receivable have not been assigned, factored or pledged without a disclosure. It's important for some receivable may be pledged or collateral factor or belong to the third parties. And for example, the review contracts, loan agreement or factoring agreements. Third, competency. All receivable that should be recorded are included. And cut off the testing ensures sales near year end are recorded in the collecting period. It means that all receivables that should be recorded are included in the account. It's important because the understated may be occur in if sales are not recorded or some receivables are omitted. Audit assessment for cash and cash equivalents. The first, the extending cash in hand and bank balance recorded actually exists at the reporting date. Verify cash counts, bank confirmation, and the reconciliation. It's important for risk of the financiary's cash balance being recorded to overstate assets. For the auditors, perform a cash count for physical cash, obtain bank confirmation for the balance. Second, right and obligation. The entity has ownership rights to the cash and bank balance. Ensure the balance are not held on behalf of the third parties. It is important for some balance may be restricted or held in trust or trust for others. For the review, bank confirmation and agreement for the restoration or pledged balance. Third, competences. All cash and bank accounts included the petty cash, foreign currency account and overdraft are recorded. It's not undisclosed or off-book accounts. Similarly, all cash and bank accounts that should be recorded are included. And it's important risk of the understating liabilities if overdraft or certain accounts are omitted. For the example, the review bank consolidation, inspection bank statement for the unrecorded accounts. The accounting treatment for bank. The accounting treatment for bank. And first, the measurement. The initial measurement at face value amount deposit. The subsequent measurements are adjusted for the bank charges, interest income, or expenses are exchange different if in the foreign currency. Foreign currency accounts translate at the close exchange rate on the reporting date. It's based on the MFRS 121. The second is the recognition. Recognized when the cash is deposited in the bank or received transfer. Recorded when the entity control the bank accounts balance are expected of future economic benefits. Third, disclosure. Disclosure restricted or pledged bank balance separately. Disclosure any signified foreign currency balance. Audit treatment for inventory. The first is a measurement. The initial measurement at cost, which included the purchase price. It means less discount or rebates. Import duty or tax is the non-refundable. Transport, handling, or and other costs directly to attribute. Conversion costs for the manufacturing goods. The subsequent measurement at the logo of the cost and the net realized value is NRV in line with MFRS 102, and the cost is equal to determined using the FIFO and weighting average method. And the second is the recognition. Inventory is recognized as an asset when the entity has a control of the goods. Future economic benefits are expected and the cost can be related to measure. They typically recognized at the point of purchase or production. And third is the disclosure. Classified as a current asset if they are expected to be sold or used within 12 months. Accounting policy for the measuring inventory by using the FIFO or weighted average method. It's totally carrying amount on the inventory by a category, which raw material or finished goods. The amount of inventory pledged as the security. Write down and trigger sales. Now for the trade receivable. First is the measurement. The initial measurement at invoice amount, fair value of contribution. The subsequent measurements measure at the amortized cost using the expected credit loss model by MFRS 9. It's presented as a net realized value, so gross receivable less allowance for doubtful debt. The second is the recognition. Recognize a receivable when the entity has the delivery goods or service to the customer and as a legal right to receive a payment. It's recorded at the transaction price by MFRF 15. Third is a disclosure, so showing the net of allowance for doubtful debt and the credit risk management policy, movement in allowance for doubtful debt and related parties receivable separately, and adding alibis. Accounting treatment for the cash and cash equivalent. First is the measurement. The initial measurement is at the face value, the amount received. The subsequent measurements remains at the face value. Foreign currency balance translate as the closing exchange rate by MFRS 1:1. The adjusted for bank charges, interest income, and the exchange difference. Second is the recognition. The recognize when the cash is received in the hand or in bank, or when the deposit are made. The included cash on hand, demand deposit, bank accounts, short-term, highly liquid invoice for treasury bill, money market funds with a majority of 3 months or less.
So now I want to present with you guys about accounting system and control activity related to inventory. First, related to inventory is inherent risk. Inherent risk, so we know about inventory always come with certain risks. First, the type of product matters. A small and valuable item are easy to steal than large one. Second, it's hard to check inventory accurately, and deciding the value can cause disagreements. Lastly, if the company buys or sells with related parties like family-owned supplier, there is a higher risk of unfair pricing or fraud. Okay, so next, key control. Key control to manage this risk, we use strong control. The most important is separating job when the people who keep the stock should not be the same people who record it. We also use pre-numbered form for every stock movement, receiving, transferring or issuing, so we can track everything. Lastly, we can limit access so no one can handle both the stock and the record. Okay, next, authorization. Authorization is another important control. All purchase and production must be approved first. This help prevent wasting money or making too much stock, especially for goods that can be expired or become outdated. Okay, the last one is misstatement risk. If inventory records are wrong, it will affect two things: the cost of goods sold and the ending inventory in the financial statement. To prevent this, we must record the right price and multiply it by the correct quantity received. Next, this is for control activity to cash, which is why important. Why important is even if the cash balance at the end is small, money move in and out often and in large amount. Cash is easy to steal and hard to track once it's gone, so the risk of mistakes or fraud is higher than with other assets. In audit, we mainly check if the cash is real. For example, exists, all the cash is recorded complete and the amount are correctly accurate. For internal control, first we have transaction circle control, that the person who handle cash should not be the same person who record it in the books. This help prevent fraud or mistake from being hidden. And number 2 is independent bank reconciliation. Once a month, someone who does not handle cash should compare the company record with the bank statement, and this help find to different mistake or suspicious activity and make sure the balance is matched. So here we have importance of auditing inventory. First, keep track of your inventory and offer a centralized view of stock. Second one is improve your delivery by managing stock out and meeting customer expectation. And third one is reduces the time for managing inventory by keeping record in place. And the third one is control your cost by making stock report for analysis of your inventory. And the last one is manage planning and forecasting by analyzing data trends.
Let's begin with audit procedure for inventory. These are the steps auditors perform to gather evidence about inventory. First of all, auditors attend and observe physical stock count to ensure the inventory recorded in the book actually exists. They also perform test counts to verify accuracy. If the inventory is stored at a third-party location, such as a warehouse or consignee, auditors confirm directly with them to ensure the company really owns the stock or not. To check cut-off, auditors review the last goods received notes and goods delivery note before and after year end. This helps to confirm the inventory purchases and sales are recorded in the correct accounting period. The next auditor also watch inventory or additions by checking invoices, purchase requisition. This ensures purchases are legitimate. Another important step is to recompute the inventory valuation by checking unit costs, totals and calculations. Finally, auditor review how inventory is classified into raw materials, work in progress or finished goods. This helps to ensure the presentation in the financial statements is correct or not. The next, I'm going to talk about assertion tested. We actually got a few assertions. First of all, we're going to talk about existence. Inventory recorded must physically exist. Auditors must confirm by attending stock count. The next, we're going to talk about completeness. All inventory owned is recorded and nothing left out. Right and obligations. Company must legally own the inventory, not on consignment. The next, valuation and allocation. Inventory is recorded at lower of cost and net realizable value, including correct allocation of costs. Accuracy. Quantities, unit costs and totals must be calculated correctly. Cut off. Transactions must be recorded in the correct period, especially around year end. The final assertion is presentation and disclosure. Inventory should be properly classified and disclosed clearly in the financial statements. The next, I'm going to talk about accounting treatments. Finally, how is inventory treated in accounting? First of all, initial recognition. Inventory is recognized at cost, which includes the purchase price, import duties, transport handling, and conversion costs. The next, cost formula. Business usually apply either FIFO, first in first out method, or weighted average method to measure inventory outflow. The next, subsequent measurement. At the end of the reporting period, inventory must be valued at the lower of cost or net realizable value. The next, net realizable value, NRV. This means the expected selling price in the ordinary course of business minus any costs needed to complete and sell the inventory. This treatment ensures inventory is never overstated in the financial statement, which is crucial because overstating inventory also inflates reported profit. Applications of auditing bank. The first complication is large transaction volumes. Bank process an enormous number of transactions every single day. For auditors, this high volume makes it difficult to review every transaction individually. Instead, they need to rely on sampling techniques and automated audit tools, which increases the complexity of the audit. The second one is reliance on IT system. Banking operations depend heavily on complex IT systems for recording, processing, and safeguarding transactions. If these systems fail, or if they are weakness in IT controls, it can lead to errors or manipulation of data. Auditors must be therefore place significant focus on testing IT controls as a part of audit. The third one is fraud risk. Banks are highly exposed to fraud risk, both internal and external. Examples include misappropriation of funds, unauthorized transactions, or money laundering. Because of this, auditors need to remain highly skeptical and design specific procedures to detect unusual or suspicious activities. The fourth one is valuation of financial instruments. All complex financial instruments such as derivatives, bond, and structured products. Valuing these instruments is not straightforward. It often requires judgment, specialized models, and market data. This makes it challenging for auditors to verify that they are fairly valued in the financial instruments. In short, auditing banks is complicated because of the large transaction volumes, reliance on IT system, high fraud risk, and the complex valuation of financial instruments. These factors make bank audit one of the most demanding areas in the profession.
Trade receivables audit procedures. Understanding and assessing risk. Review the company's credit policies, how they approve customers, and how collections are handled. Identify risk of misstatement. Testing controls. Check how invoices are generated and recorded. Test segregation of duties. Substantive procedures. Reconcile account receivable subledger to general ledger. Ensure the total of individual customer balances matches the control account. External confirmations. Send confirmation letters to customers asking them to confirm the balance owed. Audit existence. The trade receivables recorded in the financial statements actually exist at the reporting date. Completeness. All receivables that should have been recorded are included in the accounts. Valuation. Receivables are recorded at appropriate amounts and are recoverable. Rights and obligations. The entity has legal rights to the receivables shown in the financial statements. Presentation and disclosure. Receivables are properly classified, described, and disclosed in accordance with the reporting frame. Accounting treatments. Recognition. Recognize the receivable when the company has delivered goods or services to the customer. Initial measurement. Record receivables at transaction price, the invoice amount due from customer. Subsequent measurement. Recognize loss allowance for doubtful debts based on history. Pre-declaration write-off. When a receivable is deemed uncollectible, write it off against the allowance. Presentation in financial statements. Accounting policy for receivables and impairment.
Next, importance of auditing in cash. First, to prevent misappropriation and fraud. Cash is the most liquid asset, making it highly vulnerable to theft, embezzlement, or unauthorized use. Auditing help ensure proper safeguards and control are in place. And second one is to ensure accuracy of record. The recorded cash balance in the books must match the actual amount of cash held. Auditing verifies this accuracy through reconciliation and fiscal control. The third one is to evaluate effectiveness of internal control. Auditor assess procedures such as segregation of duties, authorization of payment, and documentation of receipt. Strong control reduce the risk of error and fraud. And next, to verify proper cut-off of transaction. So auditing check that cash receipt and payment are recorded in the correct accounting period, preventing overstatement or understatement of balance. And the last one is to maintain financial integrity and stakeholder confidence. So accurate cash balance provide assurance to investors, creditors, and regulators that the company liquidity is reliable, building trust in financial statement.
Cash and cash equivalent audit procedures. Understanding and risk assessment. Review the company's policies for handling cash and bank transactions. Identify risks like unauthorized bank accounts. Testing internal controls. Check segregation of duties. Evaluate how management monitors cash balances. Review controls over issuing checks. Substantive procedures. Bank confirmations. Send direct confirmation requests to banks. Bank reconciliation. Obtain client prepared reconciliation. Cash count. Perform surprise cash counts at year end or during fieldwork. Audit accessions existence. Perform surprise cash counts and reconcile with the cash book. Completeness. Ensure all cash receipts are recorded by reviewing pre-numbered receipts and comparing with cash records. Valuation. Verify foreign currency cash is structured at year and exchange rates. Rights and obligations. Confirm that cash belongs to the company and is not held on behalf of others. Presentation and disclosure. Ensure restricted or petty cash is disclosed separately in the financial statements. Accounting treatments. Initial recognition. Readily convertible into known amounts of cash, subject to insignificant risk of changes in value. Restricted cash. If cash is restricted, it must be separately presented in the statement of financial position. Subsequent measurement. Cash balances remain at nominal value. Presentation in financial statements. Balance sheet. Cash and cash equivalents shown as a single line under current assets. Statement of cash flows. Opening and closing balances of cash and cash equivalents must reconcile with the cash flow statement.
Okay, next we have complication of cash. First, fraud and misappropriation risk. Cash is easy to steal or measure, so auditor must be alert to fraud. And number 2 is petty cash and cash on hand. Small cash kept in office is harder to control and often not well documented. Number 3 is cut-off error. Cash receipt or payment may be recorded in the wrong period, causing mistake in balance. And number 4 is intercompany cash movement. Transfer between related company can be complex and may hide error or manipulation. Okay, so here we have an example of document resources evidence for cash, and we have a cash count and petty cash verification, disbursement journal, and testing of internal control over cash, and comparison schedule, current versus prior year or month. Okay, now we have importance of audited bank. First, to verify existence and completeness of balance. So we know auditor confirm all bank account are properly record and send confirmation to bank to ensure balance actually exists and are complete. And number 2 is to detect window dressing and keeping practice. Some companies manipulate bank transfer at year end to artificially inflate balance. Auditing uncover these practices and ensure fair presentation. Number 3 is to confirm accuracy of bank reconciliation. Bank reconciliation may contain error, unrecorded transaction or timing difference. Auditing ensure they are properly prepared and adjusted. Next, to disclose restriction and pledges balance. Certain bank balance may be pledged as collateral or restricted for specific use. Auditing ensure these are properly disclosed to present a true financial position. And the last one is to ensure trust, compliance and transparency. Audited bank balance assure regulators and shareholder that the company is compliant with accounting standard and financially sound, enhancing credibility.
Let's talk about audit procedure for bank. Auditors obtain direct bank confirmation from the bank. This is done to verify the company's cash balance, overdraft, outstanding loans and any guarantees. By going directly to the bank instead of relying on the client's record, auditors reduce the risk of error or manipulation. For the evidence, the main evidence is the bank confirmation letter, which is written directly by the bank to the auditor. Since it comes from an independent external source, It is considered one of the most reliable piece of audit evidence. The next audit procedure for bank is auditors inspect the year-end bank reconciliation prepared by the client. They don't just accept it, they test the reconciling items such as outstanding checks and deposit in transit. This helps confirm whether the bank balance per the company's record agrees with the balance reported by the bank. The key evidence here is the client's bank reconciliation statement. By reviewing this document and verifying the reconciling items, auditors can assess whether the reconciliation is accurate and complete. The third procedure is auditors review the bank statement at the year end and trace the closing balance back to the company's general ledger. This ensures that what the bank shows matches what the company has recorded in its books. The evidence here comes from the cash book and the general ledger, which are the client's own records of cash transactions. By comparing this with the bank statement, auditors can confirm accuracy and completeness. The next audit procedure is auditors assess whether any of the company's bank accounts are restricted or pledged as security for borrowings or guarantees. This helps identify if the company has full rights over its cash balance or if there are limitations that need to be disclosed. The evidence comes from loan agreements, correspondence from the bank. These documents reveal if the bank has placed restrictions or lines or pledges over the account. As auditors check the cut off of cash receipts and payments by tracing transactions that occurred just before and after year end to the bank statements. This ensures that cash transactions are recorded in the correct accounting period, avoiding misstatements of balance. The supporting evidence includes deposit slips and payment voucher which are matched against the bank statement entries to confirm timing and accuracy. The fourth procedure is auditors investigate any unusual or long outstanding reconciling items that appear on the bank reconciliation, such as deposits in transit or unpresented checks. This helps to ensure the items are genuine and not used to hide errors or irregularities. The supporting evidence includes deposit slips or check counterfoils which provide proof of the transaction, making up those reconciling items. The next audit procedure is auditors recalculate the translation of foreign currency bank balance using the official year-end exchange rates. This ensures the balance held in foreign currencies are correctly converted into the reporting currency and not overstated or understated. The evidence comes from published exchange rates such as central bank rates and the bank statements in foreign currency which are used to verify the translation. The next audit procedure is auditors review the financial statement disclosure relating to bank balance, overdraft and guarantees. This is to ensure that all relevant information is properly disclosed in accordance with accounting standards and that nothing material is omitted. The evidence comes from accounting standards and disclosure checklists such as IFRS, MFRS or GAAP, which auditors use to compare against the company's disclosure and confirm compliance. Accounting assertions and accounting treatments for bank. First of all, I'm going to talk about existence and right and obligation. Bank confirmations and reconciliation provide evidence that the cash balance shown in the financial statement actually exists at the reporting date and that the company has legal rights over those balance. For example, a bank confirmation directly from the bank assures the auditor that the account really belongs to the entity, not to management personally or another party. The next assertion is completeness. Completeness means ensuring that all transactions and balances are recorded. By checking the bank reconciliation, auditors can confirm that no deposits, withdrawals, or bank charges have been left out. This avoids understatement of either assets or liability. What is cut off? Cut off relates to timing. Auditors test receipts and payments that occur just before and after year end to ensure that they are recorded in the correct accounting period. For instance, a check issued before year end but not cleared until after must still be recorded in that year. The next is presentation and disclosure. Finally, auditors review the financial statement disclosures. They check that bank balance, overdraft, restricted accounts, and guarantees are classified and disclosed properly. This ensures compliance with accounting standards and gives users a clear picture of the entity's cash position. But accounting treatments. Recognition. Bank balance are recognized as assets since they represent cash resources available to the business. Overdrafts and bank loans, on the other hand, are recognized as liabilities as they represent obligations owed to the bank. Recording. Every deposit, withdrawal, and bank charge must be properly recorded in the financial records. This ensures the cash books match the bank statements and avoids misstating the company's available funds. Accrual basis. Cash-related transactions are recorded under the accrual principle, meaning they are recognized when they occur, not just when cash moves. This avoids misstating both the cash balance and the related expenses or income in the financial statements. Presentation. In the balance sheet, cash is presented as a part of current asset, while overdraft appear under current liabilities. If any cash is restricted, pledged, or held for a specific purpose, this must be disclosed clearly in the notes to the accounts following accounting standards. The next, I'm going to talk about complications of auditing bank. The first complication is large transaction volumes. Bank process an enormous number of transactions every single day. For auditors, this high volume makes it difficult to review every transaction individually. Instead, they need to rely on sampling techniques and automated audit tools, which increases the complexity of the audit. The second one is reliance on IT system. Banking operations depend heavily on complex IT systems for recording, processing, and safeguarding transactions. If these systems fail, or if there are weakness in IT controls, it can lead to errors or manipulation of data. Auditors must be therefore place significant focus on testing IT controls as a part of audit. The third one is fraud risk. Banks are highly exposed to fraud risk, both internal and external. Examples include misappropriation of funds, unauthorized transactions, or money laundering. Because of this, auditors need to remain highly skeptical and design specific procedures to detect unusual or suspicious activities. The fourth one is valuation of financial instruments. Banks all complex financial instruments such as derivatives, bond, and structured products. Valuing these instruments is not straightforward. It often requires judgment, specialized models, and market data. This makes it challenging for auditors to verify that they are fairly valued in the financial instruments. In short, auditing banks is complicated because of the large transaction volumes, reliance on IT system, high fraud risk, and the complex valuation of financial instruments. These factors make bank audit one of the most demanding areas in the profession.